Offshore Yuan weakens. U.S.-China trade talks and TikTok ban Loom. What's next for the currency? The offshore yuan has recently experienced a decline, dropping to approximately 7.15 against the U.S. dollar on Friday. This marks a retreat from the peak it reached just the day before, which was the highest in over 8 months. Investors are now approaching the upcoming high-stakes trade negotiations between the U.S. and China with caution, eager to see how these discussions will unfold. In a recent statement, U.S. Treasury Secretary Scott Bessent confirmed that the trade talks are indeed happening. He also mentioned that the contentious issue of TikTok could be part of the discussions. Bessent issued a warning that if Beijing does not approve a divestment deal concerning ByteDance, the parent company of TikTok, there is a real possibility that the platform could be banned from operating within the United States. This situation adds another layer of complexity to the already tense trade relationship between the two nations. Additionally, President Trump has hinted at the potential or a visit to China in the not-too-distant future. This could be seen as an effort to mend the strained ties between the world's two largest economies, which have been under pressure due to ongoing trade disputes. As we look forward, investors are preparing for the release of China's industrial profits report this weekend. This report will provide crucial insights into how companies are managing the challenges posed by tariffs and other trade-related issues. Despite the decline observed on Friday, it is important to note that the yuan is still on track to achieve gains for the week. This resilience in the currency could indicate underlying strength, even amidst the uncertainties surrounding international trade. What do you think about the potential impact of these trade negotiations on the yuan? Do you believe that a TikTok ban is a realistic outcome? Share your thoughts in the comments. Yuan versus dollar. The new currency paradigm for investors. Imagine a world where the U.S. dollar no longer dictates the pace of global finance. This isn't just a hypothetical scenario, it's becoming a tangible reality as the Chinese yuan climb the ranks, challenging decades of dollar dominance. But here's where it gets controversial. Is the yuan's ascent a true shift in power, or merely a fleeting challenge? Let's dive into the complexities of this evolving currency landscape. For years, the U.S. dollar has been the cornerstone of international trade and investment, holding a commanding 58% of the world's foreign exchange reserves as of 2025. Yet, its unchallenged reign is under threat. Factors such as fluctuating U.S. trade policies, exemplified by the U.S. Trade Policy Uncertainty Index, and geopolitical upheavals like the Russia-Ukraine conflict have prompted central banks worldwide to reconsider their reliance on the dollar. These institutions are increasingly viewing the dollar as a politically charged asset, which could be leveraged as an economic weapon. Amidst these shifts, the Chinese yuan is making significant inroads. By 2025, a notable 30% of central banks are looking to boost their yuan reserves, a stark contrast to the euro's more modest increase in tensions. This interest is bolstered by China's aggressive push to internationalize its currency, highlighted by initiatives such as the digital yuan and the M-Bridge platform, which alone facilitated $22 billion in transactions during its pilot phase. However, the road to reserve currency status is not without obstacles for the yuan. Stringent capital controls and restricted market access pose significant barriers. Despite these challenges, the potential for the yuan to triple its global reserve share to 6% by 2030 cannot be ignored, especially considering China's burgeoning $45 trillion digital economy and its leadership in sectors like electric vehicles and AI. Investors must navigate this new currency order with strategic finesse. Currency hedging, for instance, becomes crucial in managing the yuan's volatility amid ongoing U.S.-China tensions. During the 2018 to 2020 trade wars, the offshore yuan saw a 15% depreciation against the dollar, underscoring the need for protective measures like currency forwards and options. Moreover, diversifying geographically and across sectors can safeguard investments from currency fluctuations. A 2025 study showed that exchange rate volatility led to a 12% increase in supplier terminations among Chinese firms, pushing May to relocate operations to Southeast Asia and India. Investing in ETFs that cover a broad spectrum of Chinese industries can help balance these risks. Gold also emerges as a pivotal safe haven, with a third of central banks planning to increase their gold reserves in the near future. Its low correlation with other assets makes it an essential part of a diversified portfolio, ideally comprising 5 to 10% in gold or gold-linked assets. The euro and emerging digital currencies like the DCNY are also reshaping the landscape, with the euro gaining favor and digital platforms like Mbridge aiming to process $5 trillion annually by 2030. The dynamics of global trade are in flux. For investors, this isn't just about choosing between the yuan and the dollar. It's about crafting a portfolio that leverages these shifts, using tools like thematic ETFs for Chinese tech sectors, currency momentum strategies, and geopolitical arbitrage opportunities. As the global financial ecosystem evolves, adaptability will be key. The rise of the yuan and the recalibration of central bank reserve reflect a broader move towards a multipolar currency regime. Those who anticipate and adapt to these changes will find themselves at the forefront of a new era in global investing. What do you think? Is the yuan's rise a sign of lasting change or a temporary fluctuation? Share your thoughts and join the discussion on the future of global currencies.